Want to invest in a business that sells something people literally can't live without? Does a market smashing yield that's nearly twice as high as it usually is sound good to you? Looking for a dividend growth stock that could be severely undervalued right now? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is one of the world's largest food processors. Some things in life are nice to have, like a 70-inch television. Other things in life must be had. Think air, water, and food. Well, this company is in the business of processing basic foods. It's a critical part of the world's food supply chain. A world, by the way, that is only likely going to have more mouths to feed in the future. That's why this company's revenue, profit, and dividend should head higher and higher. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Tyson Foods Inc., which appear to be trading at a significant discount today. Tyson Foods Inc., stock ticker TSN, is one of the world's largest processors and marketers of chicken, beef, and pork. Founded in 1935, Tyson Foods is now an $18 billion by market cap food giant that employs over 140,000 people. The company has sales in over 140 countries worldwide, but approximately 84% of sales come from the US market. The company reports results across the following segments: beef, 36% of fiscal year 2022 segment sales, chicken, 31%, prepared foods, 17%, pork, 12%, and international other, 4%. Tyson Foods offers prepared foods via a number of brands, including Hillshire Farms, Jimmy Dean, Ballpark, and the eponymous Tyson. Sales by channel are split across the retail channel, approximately 44%, food service channel, approximately 41%, and international channel, approximately 15%. There are a few things that human beings need in order to survive. Oxygen and water come to mind immediately, so does food. If you don't eat, you don't survive. Beyond basic survival, though, most people want to actually enjoy their food. That often leads right to proteins. This is why there's built-in demand for proteins, but that's not all. This built-in demand is growing. There are two reasons for that. First, the world's global population continues to see its average wealth rise over time. Proteins can be unaffordable for those in the lowest socioeconomic tiers. As people gain access to more financial resources, there is a natural tendency to consume more proteins. Second, our species continues to escalate in number. The global population of humans crossed over the 8 billion mark not long ago. More people to feed only serves to put pressure on the base demand for food. All of this plays right into the hands of Tyson Foods, which is one of the largest processors of proteins on the planet. As such, the company's revenue, profit, and dividend should continue to grow over the long term. Already, Tyson Foods has increased its dividend for 11 consecutive years. A pretty decent start that could lead to something great. More than decent is the 10-year dividend growth rate of 27%, which is outstanding. However, it's also misleading. Recent dividend raises have been in the mid-single-digit range. The last dividend boost came in at 4.4%, and I'd expect that kind of dividend growth, or even worse, to persist at least for the next few years, as a lot of the larger dividend raises in the past were funded by expanding the payout ratio. To that point, the payout ratio is now 43.8% based on trailing 12 months adjusted earnings per share. Not terribly high, but also not close to 0% as it was 10 years ago. Furthermore, the business has been struggling of late, and that will put more downward pressure on near-term dividend growth, although things could improve quite a bit once Tyson Foods gets through this quote-unquote air pocket. That's the bad news. There's also good news. The stock yields 3.8%, which is nearly unheard of for this stock. We're talking about a yield that's competitive with utilities. For perspective, this yield is 150 basis points higher than its own 5-year average. Another way to look at it is this yield is almost twice as high as it usually is. So what's happened here is the market has adjusted the price and yield in order to compensate for the lower dividend growth rate. A pretty fair trade-off in my view, assuming that growth isn't permanently impaired. For income-oriented dividend growth investors, these are interesting numbers. Looking at business growth, Tyson Foods increased its revenue from $34.4 billion in fiscal year 2013 to $53.3 billion in fiscal year 2022. That's a compound annual growth rate of 5%. Not bad at all. I usually look for a mid-single digit top-line growth rate from a fairly mature business like this. Tyson Foods is right on target. Meantime, earnings per share grew from $2.12 to $8.92 over this period, which is a compound annual growth rate of 17.3%. Impressive bottom line growth. However, again, we have a growth rate that's misleading. The company's results are lumpy, so the impressiveness or lack thereof of its growth largely depends on what specific time frame you're looking at. The company saw outsized margins, particularly on beef during the pandemic, but this trend has totally reversed course. Recent results have been downright poor. For instance, Tyson Foods reported a loss for the second quarter of fiscal year 2023, its latest quarter. Margins were challenged and management is responding with improved focus and cost-cutting efforts. Like many businesses, Tyson Foods has been whipsawed. In the end though, people still have to eat, and it's hard to imagine Tyson Foods not righting the ship even if it takes some time to do so. Looking forward, CFRA is projecting that Tyson Foods will compound its earnings per share at an annual rate of negative 16% over the next 3 years. Yes, that's a negative growth rate. Not good. I'm not extremely sanguine about Tyson Foods, and it's far from my favorite business, but this is an awfully pessimistic take. Keep in mind, CFRA had this projection at negative 5% as recently as early February. CFRA wasn't exactly enthusiastic before, but this is a big change in a short period of time. On one hand, CFRA notes that Tyson Foods is, and I quote, well-positioned to benefit from the growing demand for protein, particularly overseas, as most of the protein consumption growth is expected to occur outside of the US, mostly in Asia, over the next decade from population and income growth. Tyson Foods is expanding capacity domestically and overseas to capture this growth, unquote. I mean, the basic business model is not in question. It's really a self-help story around execution. CFRA digs into that with this passage again, and I quote, operating margins in beef, chicken, and pork are currently under pressure due to high cattle prices, elevated feed costs, supply-demand imbalances, ineffective hedging strategies, the strong US dollar, and operational miscues, mainly in chicken. We expect beef margins to remain well below Tyson Foods' long-term outlook of 7% to 9%. In chicken, we sense a lot of work ahead to remove inefficiencies and improve execution. On the positive side, we like the investments Tyson Foods is making to improve productivity, including automation and supply chain planning tools, unquote. In my view, the near term will not be pretty, but if one has a long-term time horizon, the turnaround potential is clearly there. I think dividend raises over the next year or two will be very small, and it wouldn't even surprise me to see some pauses in there. However, I don't see immediate risk to the dividend, and once the business moves past this storm, dividend growth from fiscal year 2025 and beyond could pick up quite nicely. One could just wait for that turnaround to show up, sure, but the market is likely to sniff it out and start to price it in beforehand. The market is, after all, anticipatory. Overall, I think it's reasonable to expect a mid-single-digit dividend growth rate from Tyson Foods over the long term, even if it'll be lumpy along the way. Moving over to the balance sheet, Tyson Foods has a good but not excellent financial position. The long-term debt-to-equity ratio is 0.4, while the interest coverage ratio is nearly 7. Profitability is also just good. Over the last 5 years, the firm has average annual net margin of 5.6%, and annual return on equity of 16.9%. Tyson Foods has undoubtedly seen better days, but it's also hard to imagine that better days aren't still yet ahead. There are temporary executional issues present, not existential questions around the business model. And with economies of scale, an established global distribution network, and brand power, the company does benefit from durable competitive advantages. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. Since Tyson Foods is largely a commodity producer, it's more of a price taker than a price maker. Input costs can be volatile, and these costs have been rising. Viruses like flus sometimes hit animals and cause massive harm to herd and or flock health. Alternative food products like lab-grown meat could challenge the business model in the future. There's a risk that recent stumbles are foreshadowing structural problems. Tyson Foods is mostly a U.S. player, but its exposure to foreign markets introduces geopolitical and currency risks. I think these risks should be carefully thought over, but the basic necessity of the company's products also needs to be considered. Another aspect worth considering is the valuation, which looks quite attractive after the stock's 40% plus fall from its recent high. The stock's price-earnings ratio is 12.3. That's obviously well below where the broader market is at. What makes this especially notable is that earnings are basically in a trough right now. If earnings were more normal, this ratio would probably be under 10 at an unchanged stock price. Sales haven't been impacted as much as earnings, and this really shows how low the valuation is. The price-to-sales ratio of 0.3 is half of its own 5-year average of 0.6, and the yield, as noted earlier, is significantly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 6.5%. Now, there are two ways to look at this growth rate. On one hand, it's on the low end of what I usually allow for, and it's quite a bit lower than the company's demonstrated growth across its earnings per share and dividend over the last decade. On the other hand, it looks high when compared to recent bottom line and dividend growth, and the near-term forecast for EPS growth, which is abysmal, can't support any dividend growth at all. I'm looking through this valley the business finds itself in right now. An established, scaled-up business in food processing should be able to muster mid-single-digit dividend growth over the long run, assuming it stays out of its own way. Recent actions around execution show that management is aware of the situation and committed to improving, so I don't believe that Tyson Foods will snatch defeat from the jaws of victory. There is a lack of extreme enthusiasm on my part, as I just don't see sustained excellence in the fundamentals, but Tyson Foods is being priced for downright misery. If the business can just get back to normal, there's a lot of upside from here. I believe the next year or two could be tough in terms of dividend growth, but fiscal year 2025 and beyond should allow Tyson Foods to make it up to shareholders. The dividend discount model analysis gives me a fair value of $58.42. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates TSN as a 5-star stock with a fair value estimate of $96. CFRA rates TSN as a 3-star hold with a 12-month target price of $59. I came out to within pennies of where CFRA is at on this one. Averaging the three numbers out gives us a final valuation of $71.14, which would indicate the stock is possibly 28% undervalued. Here's the bottom line, guys. Tyson Foods Inc. is in the business of selling something people literally can't live without. And with the world growing larger and richer, demand for its products should only rise over time. With a market-smashing yield, a moderate payout ratio, a double-digit long-term dividend growth rate, more than 10 consecutive years of dividend increases, and the potential that shares are 28% undervalued, long-term dividend growth investors looking for a turnaround play ought to have their eyes in this direction. And now for a special news announcement. Vici Properties Inc., stock ticker VICI, is flying high. At the REIT conference, management stated that, and I quote, "economic resiliency of gaming is resounding," unquote. I couldn't agree more. This is a REIT that collected all of its rent during the pandemic. Vici owns a substantial portion of the properties along the Las Vegas Strip, along with a number of casino and entertainment properties elsewhere. The stock is up on the year, but it still offers a 4.8% yield backed by trophy properties. I see no gamble here. Thanks so much for watching. Hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and am often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who've been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.